So you ever wonder how brand new companies get started? I mean, the ones that are just a brilliant idea, maybe a prototype, and a super passionate founder? Where does that first critical check come from when banks won't even look at you? Well, today, we're diving into the world of these first believers, angel investors.
Here's what we're going to cover. First, we'll nail down what an angel actually is. Then, we'll map out the whole investment journey. We're going to peek inside the investor's mind, look at some legendary success stories and high-stakes gambles, and finally, really understand why these angels are so incredibly important.
All right, let's jump right in with the basics. Who exactly are these financial angels and, where'd they even get that name? It all comes down to solving this one massive problem every entrepreneur faces. You've got a game-changing idea, right? But you have no revenue, no track record, nothing a traditional bank would ever touch. So where do you possibly turn for that first big break?
The answer is an angel investor. These are wealthy individuals who use their own money to provide capital to a brand new company. And in return, they get equity, a little piece of the pie. The name angel is just so fitting, right? Because they swoop in when venture capitalists say it's too early and the banks just say no. They are betting on pure, unproven potential.
Now, this is a big one that people always mix up, so let's be super clear. Angels are not the same as venture capitalists or VCs. Here's the key difference. Angels are investing their own personal money in a company's earliest, riskiest days. It's their cash on the line. VCs, on the other hand, manage these huge pools of other people's money, and they usually come in much later with way bigger checks once a company has started to prove itself.
Okay, so we know who they are, but how does this whole process actually work? Let's break down the typical step-by-step journey of landing an angel investment.
It all kicks off with the pitch. This is where a founder has to sell their vision, their dream. If the angel's hooked, they move on to the evaluation. This is the deep dive, the due diligence on the business plan, the market, and especially the team. If it all checks out, they hammer out the investment terms. We're usually talking somewhere between $25,000 and $250,000 for a slice of the company. But, the best angels bring so much more than just money. They offer priceless mentorship and open up their entire network. And that final step, the return. Angels only make a profit if the startup has a successful exit, like getting bought by a bigger company.
Now let's flip the script. We know the process. But what is an angel thinking during all of this? When they're listening to that pitch, what are they really looking for?
This right here, this is the whole game. For most angel investors, the idea is actually secondary to the people behind it. Think about it. An incredible, unstoppable team can take a flawed idea and turn it into a success, but a weak team can drive even the most brilliant concept straight into the ground. They have a saying, they're betting on the jockey, not just the horse.
So besides that rockstar team, what else is on their mental checklist? Well, first, they need to see a massive growing market. Second, a product that's truly unique and solves a real pain point. They're also looking for any kind of early traction, some sign that customers are already interested. And finally, they have to see the exit strategy. How are they going to get their money back, and hopefully a whole lot more?
This whole process is a high-stakes game. Seriously, the risks are enormous, but the rewards, well, they can be legendary. Let's look at a couple of examples that show just how big these gambles and the payoffs can really be.
$100,000. What do you think this number represents? I mean, it's a pretty standard angel investment, maybe, but this particular check, this one literally changed the world. That $100,000 check was written by a guy named Andy Bechtolsheim to two Stanford students, Larry Page and Sergey Brin, before Google was even officially a company. Get this, he saw a quick demo of their search engine, believed in the vision, and wrote the check on the spot. That one single act of faith turned into a return worth billions. And it isn't always just one angel. Back in the 90s, when Jeff Bezos wanted to start this wild idea for an online bookstore, he raised about $1 million from a group of 20 different angel investors. They all took a huge gamble on an unproven idea. And honestly, without them, the Amazon we know today might have never left the garage. But for every Google and Amazon, there's a serious dose of reality. You have to see this. Angel investing is incredibly risky. About 70% of startups either fail completely or barely return the original investment. So how do investors survive? Smart angels don't put all their eggs in one basket. They build a portfolio. They know most of their bets will fail, but they're hoping that one or two will become that massive success that pays for all the losses and then some. So with that kind of failure rate, why do it? Why is this so important?
Let's wrap this up by summarizing the uniquely vital role these investors play in our economy and for innovation as a whole.
Angels matter because they do what no one else will. They write that terrifying first check. They offer their experience and their network, not just their bank account. They're the ones who believe in raw potential when there's no proof yet. And in doing that, they fuel the entire engine of innovation, building the bridge that takes us from a dream on a napkin to a world-changing company.
In the end, every single great company you can think of started with just an idea and a founder looking for that one person to believe, which kind of leaves us with one final thought. Is your idea ready for its angel?